So, with no further ado, I'm going to hand back over, as I said, to the El Supreme moderator for the day, Mr. Toby Potter.
Thank you very much, Matt. And thank you. This is, I promise this is the last time you'll see me here. It's my pleasure to welcome Caitriona Wortley and Cam Gleeson from respectively Drummond Capital Partners and Betashares to join with me to talk about core and satellite and how that works. And Caitriona's product has already had a big plug from Alex Donald in the first session, because it is indeed the Drummond Capital Partners private markets SMA that he was talking about. So please join me. Now, in this session, we're going to talk about one of the fundamental ways in which managed accounts are actually delivered to clients, and one of the core components of overall portfolio construction, which is the managed account and its satellites. So we're going to be talking about core and satellite construction, both within a managed account and managed accounts within an overall portfolio. So as I mentioned, Caitriona comes from an organisation which is sort of fundamentally a believer in active. Another one from the previous session. Cam from an organisation which has built its reputation on a fundamentally passive approach. But we're going to see a good deal of similarity in portfolio construction thinking, given the different starting points they start from. So why don't we start off, Caitriona, talking a little about Drummond and you know who you are and what you do, for those who.
Yeah, absolutely. So Drummond, we're one of the, 590 consultants in market? Not really. But we don't actually classify ourselves as a consultant per se, more of an investment manager providing multi-asset solutions and broader advice solutions for wealth management groups. I would say we fundamentally believe in active management, Toby, but I would say that's particularly around asset allocation, active asset allocation, both strategic and tactical, where we are, I suppose, thinking about core satellite in particular, we don't have a dogmatic style that has a rigid approach to core satellite that, will force a choice or a specific breakdown of allocation. It's much more pragmatic in style, where we, will make our decisions based on the environment. But typically, we will always have a blend of call it core satellite or passive and active in our portfolios. And the breakdown of that, changes over time, and also changes with respect to different asset classes. But we are very fee conscious. Our clients and their clients are very fee conscious overall. So, being very disciplined. Sorry, this is echo, is there? So being very disciplined with that fee budget of where to allocate is important. And so, I would say we always anchor our portfolios with passive exposure and complement and save our fee budget for active strategies where we are pretty sure on the outperformance coming through. We typically would have about a third passive, 2/3 active in portfolios. And, I think across asset classes it varies, but, say for example, Australian equities in large cap, we do have a strong anchoring of passive in there. I think a lot more active managers have struggled to have really consistent, strong outperformance over the longer term in that. And we do still have active managers, but we have a very strong anchoring of passive. Small caps, on the other hand, we have a preference for active managers in small caps, given the consistent kind of outperformance of managers in that space. Fixed income, we look at credit and government bonds as very separate asset classes. You have obviously the inverse selection, the adverse selection effect with fixed income, and so that's particularly strong in when it comes to global government bonds. So again, with global, we do have more of a preference for active, whereas Aussie, less parameters at play, and again, the active managers have struggled a little bit more over the long term in terms of performance. So we prefer passive. So I could go on, but it's fundamentally it's definitely we do believe in passive, and we do believe in active. Yeah.
Cam, thinking about Betashares portfolio construction methodology. Obviously, you come from a passive market linked approach. So how do let's start off with what your sort of default portfolio construction methodology would be, and then we'll sort of explore how that becomes the basis for a core and satellite approach.
Yeah, so that's probably a great place to start. So, we're most well known for our range of passively managed funds. We do have active funds within our range. Our managed accounts are designed around accessing low-cost, broad market beta in asset classes. We think that makes sense. But we also do use smart beta exposure, particularly in Australian equities, particularly when we look at fixed income. We think there's opportunities for smart beta to add value and complement beyond broad market beta, if you like. And so I think what that provides as a value proposition is that we can access really cheap, efficient exposures to smart beta, along with that lowest cost market beta, create a really good return outcome, which is going to be stable, robust over the cycle at a very low price point. So the management fees between 20 basis points and 15. So very cost effective core exposure. And for a lot of clients, that's enough. That's what they want to see their clients invested in. But when we start to talk about core and satellite, we often see that an advisor will have, a view that having that core is important, but they might have a particular client who is, wedded to a particular investment topic or idea. And that's where we often see an advisor able to sort of differentiate the ownership, if you like, for the investment outcomes within the portfolio. And essentially, they'll have ownership of that core and what that's delivering over the journey. But if the client is particularly interested in whether it be cybersecurity or uranium miners or some individual stocks, or perhaps they have some legacy positions, they can allocate satellites to those particular exposures. And where we talk to clients with a lot within our team, investment strategy team, is how do I combine those sorts of elements in my portfolio, which may or may not be Betashares exposures, with the core? How do I size them? What sort of risk characteristics do these introduce to the portfolio? How does this sort of operate as a whole? And really looking for exposures that in satellites are typically talking higher volatility. How do I make sure that volatility from the satellite doesn't spill over and impact the overall portfolio risk characteristics?
Let's talk about what core and satellite actually means, because it is a phrase which is sort of bandied about, and you've just touched on an example where the satellites are client specific. But core and satellite is also, a portfolio construction methodology where the whole thing is core and satellite. I mean, so Caitriona, how do you see advisors, or do you see advisors adopting that core and satellite approach as the standard, as opposed to client-specific portfolios?
Yeah, I mean, I would say pretty much all our clients, I think, but also not just Drummond clients. I think pretty much the majority of practices I talk to in market, the starting preference is that core satellite approach to managing money. I think it's really become entrenched in the market. I think we, as talked about, we run best ideas portfolios. We're big believers in that across your segments as the core part of the investment solution. But what is different, and where we spend a lot of time when working with practices, is actually doing extensive work in the segmentation and thinking about actually what are the blends, what are the satellites, additional satellites to that core portfolio that you want for a particular segment. And it's I think that's where it can be really powerful. So rather than trying to just build a bespoke portfolio that's across all your clients, thinking more of it as a segmentation lens and thinking about the blends of solutions that you can tailor to create a certain outcome for a segment of clients. And so, we've even been collaborating with Betashares a lot on this at the moment. where, for particular practices, it's something I'm seeing. This is a bit of a personal observation, I suppose, but seeing a big resurgence, particularly over the last 12 months in the MDA structure. I don't know, anecdotally, I probably think it's because of the M&A activity that we've seen in market between practices, where you've got firms coming together with maybe differing investment philosophies, very different segments. There's a lot of benefits for them coming together, but sometimes the investment side can be a challenge. So the MDA structure is really allowing for those businesses to think about their segments, thinking about their investment philosophies, and then the implementation can be slightly different. And so you can take that core satellite approach and apply it in different ways for different segments and different parts of the client book. And it's really, really powerful for that. So I think that's where we're seeing a lot. We can maybe go into what the various satellites are or those in a bit, but I don't know if that's...
Yeah, well, I do want to go there, but I do want to talk about this, to come back to your point, Cam, about the advisor who says, my clients have this thing, they have a personal tax issue, bought CBA at $60, now it's whatever it is, 160, and so that's their personal tax problem. Or we've always liked dealing with Pendle and their monthly income fund, to pick a case at random. So lots of our clients have that, but it's not in the model, so on and so forth. So how should advisors model up the impact of satellites on the core?
Yeah, I think that's critical, right? Because if that end client had a very strong view that they particularly liked, whether it's the CBA shares they hold, you need to understand the overall impact that can have on risk on the overall portfolio. Yep. And look, it might be a discussion that perhaps we sell a little bit of that down because overall your volatility is getting blown out by this massive holding. But it certainly allows either some preservation of ownership for that end client, but just thinking about how that plays a role in the overall mix is important. I mean, just to talk a bit more about our philosophy in terms of that core, our belief is that, really important characteristics of core are things like low turnover, holding for a long time horizon, because tax impacts can really eat into your after-tax return. So, thinking about how I can sort of maximise my value to the client, not just in terms of performance, keeping up with markets in different cycles, but educating the client on tax consequences of using a robust core, and then talking to them about whatever legacy positions they have and whether they're appropriate, what they're doing to risk, how you can fund, say, tax consequences of selling down that bit of CBA at the same time.
Caitriona, I mean, how does Drummond help, or how should advisors model both the client-specific satellites, but also the sort of broader organisation-wide core and satellite approach that you spoke about?
Yeah, so again, we do, I suppose we do a lot of work with the modelling and stuff as well as Cam mentioned, for either practice-specific or segment-specific or client-specific situations. But I think, we're always looking at it at what is the best combination of solutions, including satellites that meet that segment or client need in the best way. I suppose what are the satellites we're talking about? So yeah, it could be the direct equities, it could be retirement solutions. So for example, we have a retirement modelling tool that's importantly stochastic modelling based. I'm very passionate about that, and so being able to look at the whole client's situation from that probability of outcomes lens, and so modelling that as an entirety. They obviously, retirement solutions currently don't fit in the managed accounts and need to be held as satellites. And then another segment is you touched on private markets, and it's probably where we see the most, I suppose, of our modelling work being done to assist with supporting advisors on implementing private markets to the advice solution for a client. So we've built a modelling tool again that advisors can use to blend the private markets with the core portfolio and really looking at the outcomes of that, depending on what the private markets SMA is, tapping it into the client's objectives. And so I guess the power of that is, again, we're, as I said, big believers in that best ideas portfolio, rather than trying to spend your time choosing between, Fund A versus Fund B, thinking about actually the blend of solutions that you're putting together, whether it be passive, active, private markets, thinking of it in that way for your segments just can lead to such an awesome investment proposition.
I can give one concrete example just from this week of a client who was interested in incorporating some Bitcoin exposure to their traditional portfolio. I'm not sure you heard the phrase getting off zero, this whole idea that investors with traditional portfolios should look to add a small allocation. So just doing some modelling, what happens if you were to add, say, 0.5% of Bitcoin in terms of your overall portfolio, 1%, 2%, up to 5%? What does that do? And I think it's important when you're looking at that sort of modelling, not just to look at the potential returns based on historical returns, but to look at the risk in particular. Like, what does that do? Not just the volatility, what's the risk of catastrophic loss from a drawdown, those sorts of things.
High if you invest in Trump coin or Melania coin.
Very high, yeah. So just thinking about particularly the risk side of things, rather than perhaps anchoring the advisor in what's been a very strong performing, potential satellite, and the implications from that sizing. How much are you allocating? Finding the sweet spot that they're comfortable with from the risk.
We've talked about a couple of examples as we've gone along. You talked about retirement, a retirement approach. We talked about private markets. These are all kind of systematic ways of dealing with core and satellite. So let's try and draw out what some of the most common core and satellite instances or use cases are, and how they get actually articulated or expressed.
Sure. If we sort of think about core and satellite going back, say, sort of even 5 to 3 years, most of the allocations to satellite were typically either a legacy position that someone might have, or alternatively, allocation to some sort of structural growth theme. Or indeed, in our case, the way people would think about satellite may well be an active manager, someone they've got high conviction in. And so we saw a lot of interest in growth equities, if you like, in satellites, be it cybersecurity or something of that ilk. What we're seeing increasingly now is, I think we talked a bit about this, but the use of satellites for something other than looking to drive strong growth, whether that be income or access to private markets. Obviously yields are down in the Australian equity market, so if I can add something, if I've got a need for yield, I like this core portfolio, but I need to boost my overall income, how can I do that, whether that be from fixed income, from private markets, or from equities? And then alternatively, thinking about that portfolio as something which is going to be dynamic, but wanting to add some private market exposure, which may be liquid now, but has the risk of illiquidity in the future. So using my satellite exposure for whether it be private equity or indeed private credit is something which we're seeing increasingly in client portfolios.
Yeah, I think we're going to continue seeing a lot of innovation in this space, particularly on the private side, as talked about. You mentioned, Alex, mentioned earlier about the private markets SMA, which we launched last year. That was, I suppose the evolution of that's interesting in that we've, for a number of years, we've been providing the clients who use us for their core SMAs and MDAs, we were providing kind of best ideas research with respect to private markets, and we would write a client brochure, but it was advisor client led, so the advisor would take the opportunity or the deal to the high net worth client, and they would invest. And so, we heard the rhetoric going, from clients back, we love this, it's great, but it's labour intensive, it's inefficient. We love managed accounts, so can you build a managed account or a portfolio solution for that? So we worked with Armbar closely on that and built the first evolution of that, which is private equity, private credit and real assets. At the moment it's for wholesale investors only, but it will convert to retail shortly, and that's been a function of the product development from managers, converting their wholesale IMs to retail PDSs. So So I suppose there's the broad exposure that you can get from private markets that really enhances that overall outcome for the client. But increasingly then we're seeing very specific use cases. So, we'll soon be launching like a retail private credit monthly income. So again, for clients in pension phase, for example, rather than just build an income portfolio of the core liquid stuff, actually focus on more best-in-class solutions to blend together as the satellite to that core portfolio for clients that need extra income, and then that evolution goes further with respect to further wholesale portfolio options, taking more illiquidity. But really, the managed account structure is the optimal kind of way for that, because you maintain the transparency. The liquidity is much more preferable than a fund of funds. The fee layering, you're cutting out a layer of fees. So it's from a client perspective, it's really powerful, and it's why we went down that path.
Are there questions for either Cam or Caitriona? Can I? You used the word real assets there. Let's come back and talk about the sort of instance of real assets, with the definition of illiquidity. So that how do they play out in a core and satellite world?
So within our managed accounts, we've got an allocation to infrastructure, which we think of as real assets. This is obviously public or listed infrastructure, which has a slightly different dynamic from a risk-return perspective. Tends to be a little bit lower return than, say, global equities, lower risk. We think that's a good tool from blending. But importantly, because this is listed, it means that if there is, say, a risk-off event, we have the ability to rebalance. We've seen, interestingly, if you look at real asset unlisted infrastructure funds in Australia, there's been a bit of movement there with super funds, seeking to adjust their infrastructure holdings, and some of those large institutional funds, I guess, have seen a bit of selling pressure from people looking to exit, and this sort of talks to the fact that there can be advantages to accessing publicly available alternatives, and infrastructure, I think, is one where you're starting to see some of the I guess issues around illiquidity in that sort of large unlisted space.
Okay, so look, I want to come back then and just sort of wrap up in thinking about the role of core and satellite as opposed to the kind of standard managed account offer, and how you see it developing as a tool, as a sort of structured tool that advisors can use. How do you see it evolving?
Do you want to go?
Yeah, sure. Look, I mean, fundamentally, we believe in using low-cost, well-diversified building blocks for your portfolio, but we also see that there is a lot of interest in, if you like, a barbell approach. If I've got like a fee budget to spend, where do I want to spend that? And I might believe the best way to produce outperformance is going to be through, for example, private markets. And so using a barbell approach of really anchoring in these broad diversified exposures, which we think are very well efficiently run, good tax outcomes, together with spending my fee budget where I think it's going to have the greatest impact, can be a really powerful approach. And that's one way we're sort of talking about core and satellite, right? Like, spend your money where you think you can add value, and then be really ruthless and efficient with the core.
And giving options, I suppose, as well. Like, we, while we usually partner with businesses and we're the majority of their wealth offering, like, there are situations, as I mentioned, increasingly so, where I feel working with, say, for us working with a Betashares, to be able to again provide even an extra layer of blending opportunities for the client in that core satellite. So they may choose to offer a Drummond with a certain value proposition, and we're really big on the reporting comms and that client engagement piece, but you can have a low cost portfolio as well if you want to further blend that with the active approach. So giving more levers, I think, to the advice practices with, again, to cater to the various segments that they have in the best way, and by, them saying, we're partnering with Betashares, with Drummond under, obviously an MDA will give the most flexibility with that kind of a structure. It just can lead to such an awesome, investment proposition overall.
Right. Well, last chance. No? So please join with me in thanking Caitriona and Cam for this session.